Hey, everyone. Let's talk about some institutional detail on futures markets, forwards as well, and how they sort of relate to this idea of centralized clearing that was discussed as being so important for systemic risk in our prior talk. So we already know a bit about futures, right? They are available on a wide range of underlying assets. Futures are traded on exchanges, forwards are traded over the counter. The specifications that need to be defined in the futures contract or a forward contract is what can be delivered, where it can be delivered to, and when it can be delivered. Indeed, futures can actually allow for delivery of multiple grades of underlying asset, let's say a more concentrated or less concentrated orange juice, or higher or lower grades of corn, or even a higher or lower yielding bond. And they have built-in formulas that will actually adjust the futures price or the forward price based on what is being delivered. As far as the what part, not only does the price of the thing being delivered matter, but also how much of it is going to be delivered. And in a way, the optimal futures contract size depends on the market. So, for example, if the contract size is too small, that would be inefficient for the needs of whoever the market is catering to, simply because it would need to buy multiple futures contracts, paying some transaction cost for each. If the futures contract size is too high, that would be inefficient because then an individual market participant may not be able to take advantage of it. So in a way, the market evolves to sort of custom tailor the size of a contract to the needs of its participants. And this is also why you often will see mini futures contracts, such as the S&P E-mini, which essentially allow both smaller scale and larger scale investors to participate in that futures market. Where the futures contract can be delivered is, of course, one of its parameters. If it's something that's perishable, there's certain storage areas that are considered acceptable, and perhaps farther away ones would also entail an adjustment to the future price. The when, in general, it is some period of time before the expiration of the futures. Sometimes the entire month in which the futures expires can be the delivery month. And of course, then trading will stop shortly before the last day of possible delivery, perhaps the end of the month. Futures markets also have price limits. In other words, there's such an idea as the market being limit down or limit up, where the price has risen or fallen so much, the trading is stopped for the time being. And futures are settled daily. Now, what we mean by settlement, we'll talk about in this discussion of how actually we ensure against default by counterparties using the centralized clearing system that involves this idea of margin that we then settle at a daily frequency. One thing that we briefly touched on in our prior discussion was this idea that at expiration, the future price and the spot price should really be one and the same. And this could happen in two ways. Either you can have a futures price that is above the spot price and they converge. Either the spot price rises or the future price falls, so that at maturity they are one and the same. Or you could have a futures price that is below the spot price, and again, they will converge to be the same at maturity. And the reason that we know this will be the case in almost all cases, except for some truly unusual dislocations, is that idea of no arbitrage. If at maturity, or very close to maturity, let's say a day before a future contract matures, it's still trading. If the futures price is different from the spot price by a meaningful margin, well, then you can, again, buy low, sell high. If the spot price is higher than the futures price, you can go long the futures, immediately have it exercised, or well, have it delivered in 1 day's time if it has 1 day to maturity, and then sell it in the spot market for that higher price, making an arbitrage risk-free profit. If the spot price were lower than the futures price at, or very close to maturity, you could do the opposite. Now, that's not going to be the case 100% of the time. There was sort of a famous instance of, in recent memory, the oil futures actually going negative simply because there was no storage for oil. So then it would not really be possible to construct a riskless arbitrage trade if you actually can't store the commodity that you're trading the futures in, that you want to sell in the spot market. But most of the time, the future price and the spot price will converge at maturity based on this sort of no arbitrage logic. Now, while prices are fluctuating in the futures market, the idea of margin is very important. So what margin is, and this is similar to margin that you would deposit with your broker for any other type of levered position. Remember, futures and most derivatives indeed are levered positions in the underlying asset. Margin is essentially some amount of security, cash, or other marketable asset that is deposited by an investor with their broker. And by daily settlement, what we mean with futures is that the balance of this margin account is adjusted daily to reflect what is going on in these price changes. And the reason that an investor in futures puts up margin is the same reason that an investor making a leveraged trade with a broker puts up margin, is to guarantee that they, or well, to minimize the risk of their defaulting on it. So if an exchange collects margin from both participants in a derivatives contract and it collects it to an appropriate level, it can minimize or maybe even rule out defaults. Traders will generally provide some initial margin, and the way that this daily settlement process will work is that margin will then be adjusted if the price moves in the trader's favor. Money will be taken out of the margin account of the counterparty and put into that trader's margin account. And if the price moves against the trader, the opposite will happen. And if the trader's margin account falls below a maintenance level, which is usually lower than the initial margin level, but not too much lower, about 75% of initial margin perhaps, they must provide additional margin that we call variation margin in cash to bring the balance back up to the initial margin level. So again, the point of this process with these daily adjustments is just to make sure that each trader has paid up a reasonable amount of capital into the exchange that they'll get back at the end of the unwinding of their position, that will prevent their counterparty from facing loss if they default on the obligations of their position. So how does margin work? Let's look at an example. We have a futures trade. We're going to take a long position in a December gold futures. In fact, we're going to take a long position in, we're going to be long 2 futures contracts. Each contract is 100 ounces, so effectively now we have exposure to 200 ounces of gold. And the futures price per ounce is 1,250. Let's say the initial margin requirement is $6,000 per contract. This would be set by the exchange. If we have 2 contracts that we are long, we must post twice that margin, 6,000 for each contract, or 12,000 in total. And then the maintenance margin, the lowest our margin account can fall, is in this case 75% of initial, 4,500 per contract, or 9,000 in total. Now, by the way, what's sort of the notional value of gold we have exposure to? Well, remember, we have an obligation to buy 100 ounces. We might not actually end up buying the 200 ounces. We could just sell that futures contract to someone else later. But we have exposure to 200 ounces of gold. And if the price is 1,250 per ounce, well, for each 100 ounces, I guess we have 12,000, or sorry, 125,000. Dollar value of each futures contract. Again, that's 100 ounces times 1,250 per ounce. But we have two of those, so really we have a notional underlying value of $250,000 in gold. And this is why you can see that this is effectively a levered bet on gold. We've put in $6,000, but we have exposure to $250,000 in gold. How does our margin evolve through time? Now, of course, we can't predict the price of gold, but one possible scenario is that prices actually fall. And that's the one that should concern us, at least when it comes to that maintenance margin. So the price of gold initially, the futures price was 1,250. And let's say that same day the settle price, which is to say the last price of the day, fell. And it fell by $9 to 241. What is the daily gain or loss to our position? Well, how do we get to this number of negative 1,800? Well, on day one, we lost $9 per ounce. We had an exposure of 200 ounces, so negative 9 times 200, negative 1,800. What happens then at settlement? Well, we put up that $12,000 in margin. Now, the sort of magic of daily settlement is we're effectively going to compensate our counterparty for their gains on the contract thus far right away. So the short party that signed this contract with us through the exchange, we of course don't really know who they are, and they may not even be the same party throughout the life of this contract because the contract can be sold. But whoever the short side is has made positive 1,800, because remember, derivatives are zero-sum gains. That means that $1,800 leaves our margin account, leaving us at only 10,200, and it goes to our counterparty's margin account. So even if we walk away tomorrow, say we're defaulting, obviously the exchange will come after us, but our counterparty won't be harmed because that 1,800 that they've made is already with them in their margin account at the end of the day. What happens if time rolls on and by day 2 the price of gold drops even more? And it falls from 241 to 238. That's a $2.70 decrease. So again, we look at a loss of $2.7 per ounce with 200 ounces at stake. That is negative $540. So again, this is a loss at settlement to us. That's how we calculate that our daily loss for day 2 is negative 540. Now our cumulative loss is now 2,340. That means that an additional $540 leaves our margin, goes to our counterparty's margin, whoever is short this gold futures, and they then earn an additional $540. We are out an additional $540. We are now at 9,660. If a few more days go by, let's say we find ourselves in day 7, the gold price has kept falling, so from day 6 to day 7, it declined by $6.30. So again, that is a loss to us because we are long. This is $6.30 per ounce with 200 ounces on the line, so that is a loss of 1,260. That's going to leave our margin account at settlement at the end of that day 7. And if we look at our margin account now, it looks like we've been making substantial cumulative losses. Let's hope this is a hedge position rather than a speculative one. What is our margin balance? Well, we ended day 6 with 9,240. We subtract 1,260 from that to get us to 7,980. And if you note, in this margin call cell here, we know that this will trigger a margin call. How do we know that? Well, remember, what was our maintenance margin? It was $9,000. $4,500 per contract for 2 contracts, 9,000 total. Now we have fallen below 9,000. At day 6, we were still okay. At day 7, we are no longer okay. So we get a margin call. That's not the end of the world. It's just the broker saying, by usually the end of the day, please deposit additional assets in your account to bring you back up to initial margin. If we can't make that margin call, then we're really in trouble. Then we actually will have that account liquidated, and if that's not enough to meet our obligations, the exchange can come after us for the difference. If we don't have that, then we may well be bankrupt. But if this is sort of a regular business transaction that we prepared for, we will probably just have some cash on hand that we will move into the margin account. How much do we have to move? Well, we have to get back up to initial margin. Remember, 6,000 per contract, 12,000 total. So how far away from 12,000 are we right now with 7,980 in our account? Well, we're off by 4,020. So that's how much we deposit, and now we are back to 12,000 in our margin account by the end of that day. And then let's say on day 8 things finally go our way, gold moves up a little, we gain 180 in our margin account. Now we actually get that $180 added to it, so we end day 8 with 12,180. And that would of course come from our counterparty's margin account. So the process will essentially evolve like this. Money will keep either entering or leaving our margin account depending on whether we made or lost money on this futures contract, depending on how the price moved. But the nice thing about it is that any gains that we make to date are going to be allocated to our margin account straight away. We can't touch it until the position is unwound, but that money is now ours, and we can't lose it due to counterparty default. So that's sort of the importance of why we have margin balances with futures positions and what their purpose is, which is to mitigate and historically really eliminate the risk of counterparty default, that whoever you struck the contract with is not going to be actually able to pay for any losses incurred. So futures are settled daily, as we now know. Closing out a futures position is actually very easy. So all you need to do is just, if you were long a futures, just go short a futures. Long plus short equals nothing. And then, of course, you would sort of settle up your account. Any margin that was yours would now actually be available for withdrawal. And that would sort of reflect your gains and losses on that position to date. And indeed, most contracts and futures are actually closed before maturity, primarily for the reason that not everybody actually wants to either take delivery or make delivery if they are respectively long or short. They may be hedging some sort of operational risk that doesn't actually require the underlying asset. And in fact, for many operations, it would be pretty cumbersome to take delivery of whatever the underlying commodity is. So you can easily close out a position by, again, just entering into an offsetting trade anytime before trading ends, a few days before that last date to deliver. How is an exchange generally set up? This is sort of the entity that ensures that Counterparty's risk of default is minimized and sets up sort of a place for everybody to trade at a lower level of risk than they could achieve by doing it over the counter bilaterally. Well, an exchange essentially has some members who provide that initial margin and daily variation margin for any positions that they hold themselves or hold on behalf of non-members. So a broker, for example, who is not a member of an exchange, must channel their business through a member of the exchange. The member of the exchange will then require that broker to put up margin as well. And so the sort of flow of margin through the pipeline would work like this. Let's say we have a case where the futures price increases. Remember, that's in favor of the long position. That's a loss to the short position. So that means that the short trader will have some money moved out of their margin account by their broker. The broker will then move that margin account to, or that change in margin, to the clearinghouse member. That clearinghouse member will deposit it with the exchange. The exchange will move it into the account of the clearinghouse member with whom the long side's broker had placed that trade, giving it to that broker, and that broker will finally deposit it into the account, the margin account, of the long position. So you can see that it's a long and cumbersome process, but it's exactly this that prevents, let's say in this case the long trader, from having received nothing should the short trader default. In other words, it's always possible that the short trader could simply have no more money. They aren't able to contribute more margin if they are margin called. Their broker may be able to contribute money if their other clients are okay, and if they are not, even the broker may default. But hopefully the clearinghouse member and the clearinghouse itself has enough other margin coming in from other members and their brokers that still the rest of the chain would continue, and whatever gains the long side would be entitled to, they would still get, even if the short counterparty was in default. Similarly, what would happen to margin if the price falls? Well, then this would be, of course, in favor of the short trade. It would be a loss to the long trade. They would have margin from their account, or they would have assets from their margin account moved to the brokers, and then to the clearinghouse, and then to the broker of the short side, and finally into the short trader's margin account. And the robustness of this system is actually pretty well illustrated by the size of the drop in S&P futures prices on Black Monday, which happened in October 19 of 1987, so some time ago, where the S&P dropped by 20.4%. So that is truly tremendous one-day change. And of course, if futures prices move similarly, that would mean that now this would be a tremendous outflow of margin from the long traders' accounts into the short traders' accounts. And predictably, with an outflow this big, many traders indeed could not make a margin call of that size. And indeed, then some of their brokers could not make a margin call from the clearinghouse member of that size because they couldn't recoup funds from their clients because their clients were effectively bankrupt. But still enough margin was available from other clearinghouse members and their brokers such that those who were actually short S&P futures at the time still received the margin inflows they were entitled to, which sort of shows the robustness of this margining system, particularly when we contrast it to our discussion in the prior lecture of Lehman Brothers in 2008, which, remember, those were not exchange-traded futures, but over-the-counter derivatives cleared bilaterally without the intervention of a clearinghouse. So this sort of illustrates the importance and systemic risk reductive ability of a centralized clearing process for derivatives.